In line with that, apart from didn't expect the tick down on the year-over-year rate, but 0.3 on the headline, 0.2 on the core. We're expecting that energy price boost this month. Of course, we know that's going to reverse next month, but this was pretty much in line. The only thing that was a little bit surprising was the rounding down and the year-over-year inflation rate on the core to 2.1 from 2.2.
How anxious does this make you, or not?
It doesn't make me anxious. I mean, I think what we're looking for here, this report's important for considering the Fed path.
Right.
I mean, that's really what people are looking for. And as long as inflation remains around the 2% area on core measures, and I think this is flagging what I expect to see on the core PCE deflator, which that's probably going to tick down to 1.9 from 2. Now, as long as we're around 2%, that's going to keep the Fed on this path towards gradually.
So you think Jay Powell looks at this and if he woke up to watch this number, he went back to sleep?
Yeah, I mean, I think this is a number that the Fed likes. I mean, what the Fed doesn't want to see is a material move away from 2% in either direction. And I kind of feel like right now, just given all the anecdotal information, a lot of what Steve just talked about, we see it in surveys. The small business survey that we had earlier this week, which was suggesting a rising share of companies that are raising prices. What the Fed doesn't want to see right now is inflation pick up and move away from this area where it's right around its target, because then it potentially have to increase the pace of its rate hikes, which it really doesn't want to do right now. And this prevents them having to do that.
Are you as worried as President Trump is about interest rates going up and what that's going to do to the economy?
I'm not, because if we look at, again, looking at surveys, if we look at that NFIB survey and small companies and their ability to access credit, there's no problems there. 2% of companies said that access to credit is their primary problem. All companies are getting the credit that they need. The Fed Senior Loan Officer Survey shows that came out yesterday. It shows that lending standards are being eased. So we're not seeing any tightening up. I mean, sure, we see it in some funding markets. Repo rates have moved higher. But as it affects the consumer, as it affects businesses, we're not seeing any material impact in terms of tightening.
What is the dollar's getting stronger and stronger.
The dollar's getting, and that's going to have its impacts, right? That will have an impact on import
overall,
prices.
That could be a problem.
But again, this is the dollar getting stronger, oil prices falling. This is offsetting some of the other cost pressures that businesses have. And businesses are facing cost pressures from rising wages, right? And we know that. We've been hearing it from businesses for a long time, and now we're finally starting to see it in the data. So the impact of a stronger dollar on lowering business import prices, lowering commodity prices, the drop in oil prices, that's all good for businesses and sort of offsetting those rising costs in other areas.
We hear that the weak dollar is good for exporting U.S. goods too, though.
Okay, so there's the two sides, right? And this is the stronger dollar is potentially going to have, and maybe a political impact there, is going to have an impact on a widening trade deficit. That's not something that worries me. I know that there are political issues there, but it doesn't worry.
What's your growth rate for the full year, and then what's 2019 look like to you?
So for this year, we're looking for a 3% real GDP growth. We had that big bounce in CapEx. I was kind of surprised by the third quarter number. I think we see some stronger CapEx numbers. But next year, looking for growth around 2.5%. These are still growth rates, even though it's slower. These are growth rates that are well above the economy's potential to grow. So that's going to give us continued declines in the unemployment rate.
Conrad, I'm sorry to go back on this, but what about the realistic implications of a stronger dollar? It hurts tourism businesses. It may make the difference if a consumer is looking at whether they're going to buy, an international consumer is going to buy a U.S.-made good or something made somewhere else. I mean, strong dollar, it's hard to say that that's necessarily good for the economy.
It has an impact on industries that are export oriented, but the U.S. is still a large, mostly closed economy. So the dollar, I don't think, has as much of an impact. Currency fluctuations in the U.S. don't have as much of an impact on U.S. growth as, say, growth in Europe or the U.K., which are much larger export-oriented economies.
So how do we know when, the worry is that the Fed always orchestrates business cycles by staying tight too long or getting too tight. How will we know when they've overshot?
The first thing is we need to see some broad measures of financial conditions that are showing material tightening, and we're just not seeing that. They've tightened from very easy levels a year ago.
That's all we worried about were relative levels. I'd never worry, but I sometimes you worry, well, if government has this much debt service, and then it only goes to 5%, but it doubles what it was. Suddenly, the government's like, "Oh my God, how do we fund this stuff?"
The 5% would be a problem from a
it wouldn't have been 10 years ago, but now it would be, right?
Because we have a ton of debt now. But I think it's unlikely that we're going to see those kind of interest rates. I think the interest rates, government borrowing rates, are going to head higher, but we're still at low levels here. We're low levels of Treasury rates, or low levels of mortgage rates. So
mortgage rates are 5%, though. Is that what's the the terminal point that you worry about for mortgage rates just on the housing market?
So I think that mortgage rates are gonna hit higher, probably closer to 6%. I mean, that's not a mortgage rate and the impacts on affordability that I think are
Historically,
massive.
it's not a big deal, but again, you're talking about the velocity of change.
We're changing from low levels, and you know, I don't see these. When it comes to activity, I think the levels are important as well. I agree that the changes matter, but these low levels are not going to result in dramatic declines in housing affordability that cause a freeze up in housing activity. I just don't see it. So, my concern would be if I think what the Fed's primarily focused on right now is these inflation reports. They're not showing any worrying signs. If they were to show a material pickup in inflation pressures and the Fed were to start hiking rates more quickly, that could be something that would be problematic for the economy, but we're just not there yet, not with 2.1% core inflation.